In a vignette that we're currently working on, I'm going to go through the qualitative and quantitative factors that we look for when we analyze investments. But this next position that I'd like to talk about, it's currently our largest position, and there are a substantial number of forces that are all working towards the same direction. Charlie Munger, we call this a Lollapalooza effect. So imagine for a moment with me that you could get these fantastic managers, these business models, these operating models, but get them at a price at which Ben Graham would love. Well, clearly at today's valuations, this is definitely not possible. But if you comb the world looking for any types of similar models, similar management styles, we've been able to find one that it's actually outperformed Warren Buffett's early performance at Berkshire Hathaway. And this is the Agnelli family holding company of EXOR. In recent weeks, EXOR has traded at as much as a 40% discount to its net asset value versus Berkshire Hathaway has been trading at a 40% premium. Part of this premium is of course warranted in Warren Buffett's excellent track record, but given the early performance of EXOR, we think that such a discount is overly penalizing it. EXOR has a combination of factors that are all going towards this Lollapalooza effect. Namely, it's concentrated and contrarian. It's not trying to compete against Buffett and Munger and 3G Capital for the same types of targets. It's going where competition is lower. Additionally, it hires exceptional management teams that have focused on return on invested capital. That's what Poundstone profiles in The Outsiders as the #1 determinant of management performance. Lastly, it has consistently shown an ability to add underlying value to its investments, just like 3G Capital has. So why does this opportunity exist? Well, the answer lies in the exchange where it's listed. Italy is the worst performing index year to date. It's in the who's who of China and Japan, all the fantastic economies you hear about on CNBC on a daily basis. This is despite the fact that consumer confidence has hit record highs and unemployment has started coming down markedly. Even if this weren't the case, it only generates 4.5% of its revenue from Italy, so it's not material to the underlying economic value of its investments. Because of the weakness in the Italian index, the discount has blown out from under 20% to as much as 40% in recent weeks. When it was trading above 40%, we doubled our position, and it now remains around 14% of our portfolio. It kind of reminds us of when Markel acquired the reinsurer Alterra. The market had a swift negative reaction and marked down the valuation of Markel. And if you would have sold back then, it would have been one of the worst decisions you made over the last 4 or 5 years. So just to be clear, we do not want this discount to narrow. This is not part of our thesis. In fact, we prefer it to stay high because John Elkann has consistently shown a willingness and ability to buy back stock when the discount was over 35%. I can't think of a better way to add value than buy back your own portfolio at almost half off. So this is what the current portfolio of EXOR looks like. It's basically a handful of industrial businesses and a reinsurer which it just purchased. It's essentially like buying Fiat, CNH, and Ferrari and then getting a reinsurer for free, or buying a reinsurer plus some of the other investments that it has and getting most of the industrial businesses for free. And just to prove the point on EXOR adding underlying economic value to its investments, let's take for instance Cushman & Wakefield. Sold it last year for 150% return. That was over 8 years, which doesn't sound so fantastic until you compare it to its best-in-class peers, which weren't able to come anywhere close to this return. This is EXOR applying a long-term focus to the businesses. Now I'd like to take you through the major investments on EXOR's balance sheet. So it just bought out the reinsurer PartnerRe. PartnerRe over the last 20 years has been an industry leader in its underwriting results. It's achieved a pre-investment combined ratio of under 100% very consistently. In fact, over the last 20 years, it's outperformed Berkshire Hathaway's own reinsurance division by 10 basis points. So a 98.9% combined ratio is essentially equal to a negative 1.1% interest rate. It's not very novel now, but over time, this sustainable cost of capital will be very beneficial to EXOR. Some skeptics may say that EXOR has overpaid for its acquisition of PartnerRe, and so yes, it paid 10% over tangible book value. But PartnerRe has consistently over-reserved for its reinsurance liabilities, and if you add back the reserve redundancies, it actually paid a 15% discount to tangible book, not to even mention a sub 10 times earnings multiple on a normalized basis. We think it's actually a pretty interesting time to be looking at reinsurance right now. Thanks to negative interest rates around the world, basically reinsurance liabilities are no longer very attractive. And so capital has been leaving the industry for the last 2 years. Early reports from January suggest that capital continued to leave the industry. This generally leads to future better pricing in the industry. Now let's talk about Fiat Chrysler, which is run by Sergio Marchionne, who is a self-professed capital junkie. This obsessive focus on ROIC has allowed him to significantly trounce his peers in the automotive universe. And that's with his stock trading at 3 times normalized earnings. Yes, everything else is cheap, but it's not 3 times earnings cheap. Even still, he's still been able to significantly outperform his class of peers. Marchionne is a capital junkie that no one seems to want to believe. So in orange, I highlight the operating profit targets that he's already committed to. The street's well below this, and they clearly think that he can't hit these targets. To be fair, he has missed a few targets in the past. Everyone always points to the missed 2012 and 2013 Alfa Romeo product launches. But he presented this plan 2 months before we found out the Greek government had been lying about its deficit the entire time, which ended up setting the entire Eurozone into a deep financial crisis. Clearly, redirecting that capital seemed to be a wise decision. And what did he redirect it to? It's Chrysler. Fiat spent $3.7 billion acquiring the company. We believe last year it actually generated $3.7 billion of free cash flow. That's net of CapEx. That's 100% cash-on-cash return. Clearly better than any Alfa Romeo would ever generate. We like Fiat for 4 major reasons, which we've previously highlighted and I'll quickly take you through now. First, it's launching these 6 major products where it currently doesn't participate today. In any bear or base case scenario, we think that's going to generate an incremental $1 billion to $1.6 billion of incremental profitability for the company. 2, it's refreshing these ancient vehicles, which are carrying very heavy incentives. They haven't been refreshed for nearly a decade. As the company refreshes them over the next 9 months, all of these incentives will be falling away. We think that's a $600 to $700 million incremental profit tailwind. And third, because there's a price lag in how commodities roll through the automotive supply chain, all of the deflation that we saw in commodities last year has yet to actually come through the income statement. If they just capture 25% of the commodity savings, and they're already outperforming this in Q1, we think that's an incremental €700 million. And lastly, because they're harmonizing the balance sheets and converging the 2 Chrysler and Fiat entities, they're able to lower the debt and cash balances, and therefore they'll be able to save on substantial amount of interest charges. We think to the tune of about €1 billion going forward. So putting all of these major drivers together, we think that 75% of last year's operating income will be incremental to the story over the next 12 to 18 months. And because of that, we think that the company is going to be significantly debt-free by this time next year. Once Moody's and S&P catch their models up to the current operating metrics, we think that the company is already hitting investment-grade credit quality. Once it does that, it will be able to actually utilize the share repurchase program that it's already authorized. Clearly, this investment grade rating can't come soon enough, as the equity is already trading at 1/4 to 1/5 of where Ford and GM trade on a forward-looking basis. Yes, that's another way of saying we think that Fiat Chrysler's current stock price is basically baking in 13% US unemployment. Another one of EXOR's deeply contrarian investments is CNH. And yes, we know ag has been tough for a few years. But CNH has been underproducing relative to retail sales for the last 4 quarters. This means without any normalization of demand, production can actually go up on a forward-looking basis. Corn has been trading for below the industry's break-even cost curve for 2 years and counting. And at the same time, the CBOT open interest is deeply negative, deeply short, essentially. And so this has always led to more constructive pricing environments. At the same time, the stock is heavily short. There's almost a month's worth of daily trading volume that's already short the stock. So we think this is an agricultural coiled spring for better production, better potential corn prices, and better potential stock prices. Because last year's EBIT margin was 7.5%, and incremental margins for new agricultural equipment are over 30%, any normalization in demand we think will see EBIT double from here. Because of some mild balance sheet leverage and an active share repurchase program, this means that we think CNH is at least a triple once agricultural demand normalizes. So now let's talk about Ferrari. The big debate over the last few years has been, is Ferrari a luxury stock? Well, it certainly sold this car for the same price as a Picasso and a Van Gogh. But even more interestingly, every single limited edition that it's launched since inception has outperformed the S&P 500. I'm gonna have to pause there and let that sink in. Maybe I should actually be pitching a LaFerrari instead of EXOR. Even if we take the worst performing F40, it has trounced the S&P over the last decade. What other products do you know of that appreciate in value after the sale? Furthermore, Demand has been recession resistant, as in the last financial crisis, sales went up. This contrasts starkly to other luxury automakers that were down anywhere from 30 to 60%. So just taking last year, car deliveries went up 6%, but incremental EBIT margins came in at 75%. This means that as the company raises production from 7,500 vehicles to 9, we think free cash flow is going to be more than doubling over the next couple of years. And because of this, Ferrari trades at an industry low valuation of around 8 times this year's EBITDA and as low as 5 times next year's EBITDA. So putting all of these pieces together, let's go back to the balance sheet of EXOR and all of its holdings. If we project forward fair value in the next 24 months of its underlying industrial investments, holding the reinsurer steady, this is what we think NAV looks like on a forward-looking basis. Basically, we think NAV is set to triple. So here we are in early May of 2016. We think an investment in EXOR is right in every way. It's right on timing. CNH, Fiat, Ferrari, they're coiled springs and they have significant appreciation potential. The business models are right. At EXOR, they've always maintained a 3G-like focus on improving underlying economic conditions at the investments. And now it has a reinsurer, which is going to turbocharge this investment model. And third, we think the price couldn't be better. It's trading at all-time wide discounts or near all-time wide discounts, above 35%. So one of the best parts about the investment management business is that we get to learn from other people's mistakes. Here's a picture of my mentor, Wally Carucci, who used to own 20,000 shares of Class A Berkshire when it used to be a net. When it traded well above book value, he ended up selling it for $35 a share. That was an opportunity cost of $4.4 billion at today's values. So as you begin to think about EXOR as an investment, just remember that painful lesson. And thank you for watching today.
If you followed all the instructional material, you just...
Set it and forget it!